This video is designed to explain the preferential rates on capital gains. The Internal Revenue Code provides for the preferential treatment for the gains on the sale or exchange of a capital asset that is held for more than 1 year. This is referred to as capital gains preference. There are different preferential rates on capital gains, so the sale or exchange of a capital asset may be taxed at different rates depending on the taxable income of the taxpayer and the type of asset. There are 0, 15, 20, 25, and 28% rates. Prior to the Tax Cuts and Jobs Act, which is effective January 1st, 2018, the capital gains rate were tied to a taxpayer's marginal rate. The Tax Cuts and Jobs Act basically left the rates unchanged, but tied the capital gains rate to a specific dollar amount that is adjusted for inflation. These dollar amounts are the amounts that previously determined a taxpayer's tax bracket. The 0% rate is for single taxpayers who have capital gains but who have taxable income including capital gains up to $38,600. If the taxpayer has income above the $38,600 and up to $425,800, the capital gains rate is 15%. If the taxpayer has income above the $425,800 rate, the capital gains rate is 20%. There are also two other categories for other types of capital gain. There is a 25% rate for unrecaptured 1250 gain. You probably haven't learned about recapture yet. Just remember that when there is an unrecaptured gain on real property, it is taxed at 25%. The 28% rate is for collectibles like artwork. Remember, the 0, 15%, and 20% rates are now tied to dollar amounts. Those amounts are adjusted for inflation and vary depending on the filing status of the taxpayers. This table provides the capital gains rates as they exist after passage of the Tax Cuts and Jobs Act. The code also provides that if a taxpayer's marginal rate is below the capital gains rate, the taxpayer's lower marginal rate applies. Thus, taxpayers in lower brackets receive no benefit from the 25% rate on unrecaptured gain or the 28% rate on collectibles. For example, a taxpayer in the 15% bracket who sold a collectible coin for a gain of $1,000 will be taxed at her 15% marginal tax rate, not the 28% collectible rate. The rate reduction for collectibles, therefore, only benefits those with marginal rates above 28%.